This video was brought to you by Ground News. It's easy to be pessimistic about Europe's economy. Growth has been pretty sluggish for the past few years, bureaucracy abounds, and the single market looks like it's getting less, not more integrated over time. Nonetheless, economic data published in the last week or so suggests that the EU is doing just fine, and Trump's hesitations, plus the prospect of structurally lower energy prices, should provide cause for cautious optimism. So in this video, we're going to take another look at Europe's economy, why it's doing better than you might think, and whether this can last. Everyone talks about the left and right of politics, but in Europe there's something new emerging, a new right. In the latest issue of our magazine, we explain this new phenomena and run through some of the elections the new right have been winning. Read more by clicking the link in the description. So let's start by looking at the data. As we see it, there are two pieces of recent data that should provide some optimism for Europeans. The first is the most recent Eurostat GDP data, released on Wednesday, which shows that the EU grew by 1.4% year-on-year in the first quarter of 2025. Now, this was above expectations and the fastest growth rate since late 2022. Now, obviously, this isn't a mind-blowing number, and it's worth mentioning that some of this was driven by Ireland's 11% growth, which was mostly as a consequence of American multinationals using Ireland as a tax haven. Equally, some of this might have been driven by front-loading of European exports into the US. In other words, Americans desperately importing European goods at the start of the year before the tariffs came into effect, which would create a temporary boost to GDP. Nonetheless, it was still surprisingly good given the global economic slowdown, and far better than, say, the US. There are also some genuinely good numbers in there as well. Spain, for instance, grew by 2.8% year-on-year, having already posted some pretty impressive numbers over the past 3 years. Similarly, in the most recent IMF forecast released earlier this week, Spain was the only advanced economy not to have its growth forecasts downgraded, and the IMF now expects Spain to be the fastest growing advanced economy by quite some margin, although these forecasts were obviously made before the power cut. Anyway, the second piece of good data was Eurostat's inflation report, which was published on Friday and found that year-on-year inflation in April came in at 2.2%, slightly higher than forecast, but still pretty close to the European Central Bank's 2% target. This is obviously good news in and of itself, but it's also extra good news because it should give the ECB the space to cut interest rates to stimulate the economy if Trump's trade wars put a further drag on growth in the future. And again, this stands in marked contrast to the US, where, while inflation did fall last month, Fed Chair Jerome Powell has strongly implied that he won't be able to cut rates even with the US nearing recession, because of the inflationary risks associated with Trump's tariffs, a move which invited the president's ire. Interestingly, almost all of this European disinflation was driven by lower energy prices, which fell by 3.5%, and this points to a wider cause for optimism for the European economy, the prospect of structurally lower prices. For context, the past few years have proved pretty definitively that high energy prices are terrible for Europe, largely because Europe is a net energy importer. Therefore, high energy prices push up inflation, undermine European industrial competitiveness, and help Russia, because oil and gas revenues give Putin more money to spend on his war in Ukraine. Now, unfortunately for Europe, energy prices have been pretty high since the pandemic. You can see this just by looking at the price of oil, which remains the most important energy source to any modern economy. Having hovered at around $50 per barrel for most of the late 2010s, oil prices surged to well over $100 per barrel in early 2022, thanks to a post-pandemic spike in demand and Putin's invasion of Ukraine. While prices came down somewhat in mid-2022, they only stabilized at about $80 per barrel, which is still pretty high by historical standards. This also understates the real costs for Europe, because oil imports are usually denominated in dollars, and the dollar was also pretty expensive, trading at near parity with the euro during this time period. However, in the past couple of months, oil prices have come down significantly, and oil is now trading at about $60 per barrel. At the same time, the dollar has lost ground against the euro, and is now trading below 90 cents. Now, both of these phenomena have been driven by Trump's unpredictable tariff policy, which have slowed the global economy and therefore the demand for oil, as well as undermining faith in the US and therefore the dollar. This has all made importing energy significantly cheaper for Europe, which has helped tamp down inflation and should improve Europe's industrial competitiveness in the medium to long term. In more good news for Europe, there are also reasons to think that oil prices will stay relatively low for the foreseeable future, largely thanks to Saudi Arabia. For context, for the past few years, Saudi Arabia has been trying to keep oil prices high, in large part because the Saudis know that Vision 2030, Crown Prince Mohammed bin Salman's ambitious plan to modernize the Saudi economy, is going to cost a lot of money. This has required the Saudis to convince the other members of OPEC+, that is the international cartel of oil-producing states, to collectively cut production. But high global prices and steep production cuts have made it increasingly tempting for other OPEC+ members like Kazakhstan, Iraq, and the UAE to essentially cheat the cartel. In other words, pump more oil than they should and rake in the cash. This has forced Saudi Arabia to unilaterally cut production. But their decision to unwind these cuts earlier this year suggests that the Saudis have essentially given up on this project of structurally higher prices and are now accepting lower prices, but will instead pump more oil to make up for the revenue shortfall. Now, this might create some tension with Trump because lower prices will hurt American shale producers, who can only turn a profit above $65 a barrel. But it'll be great for both European industry and European consumers. And things could get even better if Trump negotiates a new deal with Iran, which, assuming it involves sanctions relief, would allow Iranian oil and gas onto the international market, with Europe being the obvious buyer. This is one of the big reasons that the EU has always been keener than the US on normalizing relations with Iran. Iran could really help Europe diversify its energy supplies, especially when it comes to gas. However, while there's clearly cause for optimism, much here will depend on Trump and whether the EU and US can negotiate a mutually beneficial deal that averts the looming trade war. Nonetheless, Europe should still be buoyed by the fact that going into these negotiations, the European economy looks stronger than its American counterpart for the first time in a while, which is not what anyone expected when Trump first threatened tariffing the bloc during his campaign. But ultimately, this is a complex and nuanced economic story, and as such, there's plenty more to read about it online, with 121 sources reporting on this story exactly. The issue is, how can you be sure that what you're reading isn't hugely biased? Well, that's a problem we face when making these videos too, and luckily, that's where this week's sponsor, Ground News, comes in. For this story in particular, they've identified that at least 15 left-leaning sources and 7 right-leaning sources are reporting on it. In fact, in addition to this, they've also shown the main differences in the headlines among left and right-leaning outlets, with left-leaning outlets focusing on the more negative economic effects of Trump and his tariffs, while right-leaning outlets focus more on Europe's own internal problems. We're able to do that because of our sponsor, Ground News, whose incredible website and app lets you discover the news and pulls back the curtain on media bias. That's because every story comes with a quick visual breakdown of the political bias, factuality, and ownership of the source's reporting, all backed by ratings from 3 independent news monitoring organizations. But one of the best parts of the app is their blind spot feed. It presents you with stories and articles that haven't been reported on by one side of the aisle or the other, helping you better break out of your media bubble and discover what those on the other side of the political spectrum are really saying. This is all in addition to the bias distribution we mentioned earlier. And together, these fantastic features help you to figure out exactly who's behind the stories you're reading and what agenda they might have. Ground News is such a useful tool for our current media landscape, and I think that an app like this will only become more essential as the media landscape continues to evolve. So if you're interested in everything that Ground News has to offer, you can get 40% off the Unlimited Access Vantage plan by using the link in the description, or by scanning the QR code on screen. And this offer is only available here, so make sure you go to ground.news/TLDR or click the link in the description to get started and support an independent news platform working to make the media landscape more transparent.